Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So here we are, stalking a profile of someone who went to UCLA and Harvard Law, and I think she's a California IP attorney. So let's see how much student loan debt she has and see what's up.
How much I owe in student loans 1 year after graduating from Harvard Law. For background reference, last year I made a video showing you how much I owed in student loans at the time, and so I wanted to make an update and show you how much I've progressed since then. Last year, my law student loans totaled that much, and I had various interest rates ranging from about 5.5% to 7%. Since that video, I've refinanced my student loans and now pay 3.57% interest. Since I graduated, I've also been paying more than the monthly minimum requirement, but I'll show you what my normal monthly payment would be as well. Those two bigger numbers are the amount I still owe, the $60,000 and the $138,000 number, for a total I will put in the text. Those numbers combined are my minimum monthly payment. So yes, I still owe a ton of money, but I only started my job in October and was taking the bar exam before that. So I've only been paying off for about 6 months, and I was very happy to get it under that $200,000 number.
Yeah, that's pretty good. So she started in October, so it's 5 months plus three. It took about 8 months to be at 40,000. Not bad. And also, it says in the comments right here, for everyone asking, my salary is 190,000. So if you make 190,000 and you live in California, that's about a $10,000 a month after-tax salary. So um, sometimes when you live in places like New York and California, $10,000 doesn't necessarily go a long way, and that's because the rent is so much higher there than in other places. Now, if you make $10,000 and you live in Arkansas, oh man, you're killing it. But rent in California is really expensive. And I don't know where she lives. She lives in LA or NorCal. But either way, you're going to pay up the wazoo in rent, right? So let's go ahead and simulate what it might like, what it might be like to pay off debt in her shoes as a $190,000. It's probably more now because this was made in 2021, and she's legally Sammy, right? She's legally, I can't say legally blonde because they'll probably sue me. No, I'm just kidding. But yeah, I mean, it seems like hopefully she's still in the field because I know that, you know, I heard a statistic that most lawyers don't last past the 5 year mark, because probably because of stress and it's maybe no job. But she's one of the good ones, right? She's one of the good ones. 190,000 in California, probably makes 200 something now. It's 2026. But let's go ahead and see what it's like to simulate her debt payoff. So um, this is about what 190,000 would be in California after tax. And not only were we going to assume that we have that giant student loan of 223,000, but we're also going to assume we have 5 credit cards and auto loan, but no mortgage this time. So I'm assuming if she's living by herself, she'd probably pay around $3,000 in rent, probably like a 1 bedroom apartment or something like that. And then if she pays for a house, probably like 3 to 5 grand a month in rent, right? And then on top of that, we have $2,000 expenses. Now, I don't know, what her actual like expense budget is, but we're just gonna pretend it's like $2,000 a month, right? And so I don't know if it'd be worth it. Like if you told me that this was like Arkansas, I'd be like, yeah, heck yeah, you're gonna pay off that 200 something thousand dollar debt with a $10,000 a month salary in Arkansas, but California's like, that's really hard. Well, at least I think it is. Like you have to have like a $300,000 a year salary just to be able to qualify for a mortgage. I think in California or the Bay Area, right? So let me just type 300K a year salary needed for Bay Area mortgage. Is that right? Minimum required, right? So 190 is like half of what you need in order to get a house in the Bay Area. Okay. All right, let's go ahead and get started with the debt payoff simulation. And what do we do in this channel? We just pay it off using something called velocity banking. So what is velocity banking? It's just basically a debt payoff strategy where you just don't save money and then use a line of credit to help pay off your debt, right? So as you can see here, we have the income of $10,333, expenses of $10,399, and -$66. So we're negative here. And then here we have 5 credit cards, an auto loan, a student loan, and then we have rent and other personal expenses. So all of our personal expenses would be about like $5,000 a month, right? Unless we had a mortgage. If we had a mortgage, then that would be considered part of our debt. But rent is just a personal expense that we'll never, see again, right? Because we're just paying it to the landlord. So what we're going to do is with velocity banking is we just create the same income, same, or we assume the same income, same budget, and we don't save money, right? That's kind of like the first step to velocity banking, which is we're not going to save money, and our checking account is the middleman rather than the final destination of our money. Okay. And then also we're going to rank our debts, right? So I have to kind of change this font. Usually, rent, I don't like to calculate or do budgets with rent just because I like to be lazy and assume that we're homeowners and we're going to pay off all our we're going to have access to something called a home equity line of credit. But because we don't have access to something called a home equity line of credit, we're probably going to have to use a personal line of credit in this case, okay? So what we're going to do is we're going to rank our debts using something called a cash flow index. And so here we have the balance, and then we divide it by the payment, and then we get a number, and this number is kind of like a ranking system, right? So the lower the number, that's the debt we want to pay off first. That's really what that is. The lower the number, because of how much bang we get for a buck. So for example, if I pay this $223,000 student loan first, I only get $2,200 back in my cash flow. Whereas if I only pay 30,000, I get $1,000 back in my cash flow, right? So which one gives you more bang for your buck? Obviously, this one does, and this is why we have to pay it off last. Okay, so dang, like I'm kind of jealous though, because like she's got the prestige, and I'm pretty sure there's a lot of people admiring what she's done. But it's all good. It's all good. Maybe I could be a lawyer. I could go to law school, and then I'll be like, after year one, I probably just drop out and then be like, what do I do with my life? And spend like $100,000 in the first year of law school. All right, so let's go ahead and do that. And then now this is what we're going to do. So what we're going to do is assume that we have access to a huge line of credit, which we're probably not going to, and we'll say it's 15% because that's like the average interest rate I've seen in a personal line of credit. And usually the personal lines of credit have much lower limits, like 15,000. So if you have like a home, you could get a home equity line of credit for 8% and like 80 to 90% of the equity. But with the personal line of credit, it's much less. But because I'm lazy, I'm just gonna say 100,000. Okay, I'm just gonna say 100,000 because I'm lazy. And if you want to see a more realistic scenario, go ahead and join the YouTube channel. Okay, join the YouTube channel, 99 cents. You could see a real life live stream where I paid off 22 debts or simulated pay off 22 debts when there was $4 left over in the budget. All right, so let's go ahead and do that. And what we're gonna do is get these low cash flow index numbers. Okay, low cash flow index numbers, and which would be the credit cards, and move them into the line of credit. So that's 84,000, 84000, right? And then once we've done that, think of this as a credit card balance transfer. You're just shifting debt. Oh my goodness. Whoopsie. We literally went from negative $66 to $2,761.15, right? And then our final step, okay, is we're going to put our entire paycheck, 10 grand, into the line, take our expenses out, rinse and repeat over and over again. All right, so we're going to keep doing that. Now, if I were in her shoes, I would just probably live with mom and dad so I wouldn't have to pay rent, right? If possible. So, like, I just would not pay LA rent. It's just like, no, thank you, right? Yeah, but a lot of people do, which is why the rent's so high in LA. A lot of people want to pay the LA rent, which is unfortunate. All right, so to get the next month's balance based on the previous month's balance plus previous month's interest, minus um, the the cash flow. So what is the cash flow? It's 2761.15, and then we're going to go ahead and copy and paste, right? And let's go ahead and do that. And so now copy and paste. Okay. And then how long does it take for us to pay off the credit card debt? Ooh, it takes us about 39 months to pay off that credit card debt. So even though we're making a $190,000 salary, that credit card debt is a killer, right? And that's because we're paying a lot in rent. Now, in other situations, I've done it where it's like the mortgage is like $900 because it was a $220,000 house. That's not going to happen in LA. That's not going to happen in LA. But at least we got rid of the credit card debt in 39 months. So let me go ahead and do that. So I'm going to just do this 39 months, and that's 85K of debt. So I'm going to go ahead and do this. And then what we're going to do, okay, is in 39 months, how much does the auto loan be paid off? I just put in 39 in our um, loan calculator right here. We have $7,000 left in the auto loan. Let's use the cash flow index model. And I'm just going to go ahead and do this. Okay, so that's plus 7343.23. Okay, and then because we moved the auto loan into the line of credit, we're going to get extra $359 back in our cash flow. So our cash flow is more than 3 grand. Okay, so I'm going to go ahead and update that. And then this is going to be minus 3120.53, right? And then we see that in 2 months it gets paid off. Okay, so now I'm going to, in 41 months, we paid off 105K. Okay. And then now the last thing that we have to pay is that student loan at that cheap 3.57% interest rate. So what is the current student loan balance? It's at 41 months, right? So I'm just typing 41 here, and then oopsie, that's 31, 41. And we see that it's getting paid off relatively quickly because of low interest rates. So most of your payment is just going to principal. And so now we have two options to pay off this loan. We dump the entire cash flow, or we can move into a line of credit. Now, we have to be a little bit careful of moving a low interest rate loan into, let's say, a 15% interest rate line of credit, right? Well, sometimes you hear on the internet, just move that whole thing into a line of credit loan bad. And that's actually not true. That's actually not true. However, if you do want to use a line of credit, and I think it's an easy way to pay off the loan, right? Because you're just putting all your money into one place and just not having to think and making it work for you. That's literally it. Okay. So let me just go ahead and just show you what we can do here. We can just do something called chunking, which is just moving a piece of the loan into Z line of credit. Okay. So let's see. I just need to type in the loan details right here. So what's the original loan balance? It's 223,000. So 223,000. The current balance, right? The current balance is 155,559.68. Okay. All right. So I'm going to go ahead and do that. All right. And then this is going to be 10 years, right? And then the interest rate is 3.57. And then the payment amount is 2212.47, 2212.47. And then let's do this. Interest rate 15%. And how much are we making? We're making 10,333. Okay, so 10,333. We'll just do $11,000 chunk. Move that into the line of credit. And then what's our expenses? Everything except for the loan we're trying to pay off. So it's 5,000, the rent and your other expenses. Okay, and then bam, paid off in 2.6 years. All right. So we only saved $9,000, $10,000 of interest, right? Most of it went to principal. So let me just go here. So I'm just going to do 0, and then it's 41 divided by 12 plus 2.6 years. So that would be 6.02 years in total. So based on, if what we have here, right, just kind of guessing that maybe her results might be similar. If it only took us 2.6 years to pay off the student loan, I'm guessing that she's already had her student loans paid off because this is posted in 2021 and it's 2026 now, right? So she must be really raking it in, kind of, I guess. But yeah, I mean, good for her, right? She went to Harvard, she went to UCLA. It's almost like Legally Blonde, but it's not. It's Legally Sammy, right? All right, well, that's it for today. Actually, let me see when is the last video that she uploaded. 2021. I wonder what happened. Like, why stop posting? She got 1.3 million likes. So, uh, girl, are you okay? I'm just taking a social media break, but I'm all good. I wonder if this is an AI because there's that thick dash. Anytime I see a thick dash, I always think, oh, this person used AI. And I always get emails like that all the time too, because I think too many people are afraid of their own voice. All right, well, that's it for today, folks. Career Mentorship. Have a great day, and I'll see you on the next video.